If you're in your 20s right now, you have a once-in-a-lifetime financial advantage that people in their 30s, 40s, and 50s would pay anything to get back. And the strange part? Most people waste it. In the next few minutes, I'll show you exactly how to start investing, even if you're starting with very little money, and how small amounts today can turn into serious wealth over time. Investing can feel confusing at first. You hear terms like ETF, IRA, 401k, and it sounds complicated. At the same time, you're dealing with real life, rent, bills, responsibilities. So investing feels like something you'll figure out later. But here's the truth. Waiting is the most expensive mistake people make. And one more thing. Even if you're in your 30s or beyond, you're not late. Starting now still puts you ahead of most people. Before we can even begin to talk about where or what to invest in, there's one fundamental concept you absolutely need to grasp. It's the single most powerful force in the world of finance, and understanding it is the key to unlocking serious wealth over time. This concept is compound interest. So what is it? Put simply, it's the process where your money earns returns, and then those returns start earning their own returns. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger, and moving faster and faster. Your initial investment is the small snowball. The returns are the new snow it picks up. Over time, the effect becomes exponential. This is the engine that will power your financial growth for decades to come. To truly see the incredible power of compounding in action, let's look at a classic story of two investors. We'll call them Alex and Sam. First, we have Alex. Alex is diligent and decides to start investing early. Alex starts at age 25, putting away $200 each month. Alex does this consistently for 10 years. By age 35, Alex stops contributing completely. Total out-of-pocket investment, $24,000. After that, Alex adds nothing. The money sits and works untouched for 30 years, powered by compounding. Now let's meet Sam. He starts investing at the exact age Alex stopped, age 35. Like Alex, he invests $200 every single month. But unlike Alex, he doesn't stop after 10 years. He keeps investing that $200 a month, every month, for 30 straight years, all the way until he retires at age 65. His total investment out of his own pocket is a massive $72,000. Now, for this example, let's make one simple assumption. Both Alex and Sam earn an average annual return of 7% on their investments. This is a historically reasonable, though not guaranteed, figure for the stock market over the long term. So, who comes out ahead at age 65? Despite investing 3 times less money, Alex, our early starter, ends up with approximately $406,000. Sam, who invested consistently for 30 years, ends up with approximately $245,000. Think about their journey from ages 25 to 65. Alex's money grows for 10 years, then compounds for 30, accelerating. Sam starts later and never catches up. Time wins. Let that sink in. Alex invested $48,000 less than Sam. That's 3 times less money. But she ends up with over $160,000 more at retirement. How is this possible? The answer is simple, and it's the most valuable asset you have as an investor. It's time. That decade Alex had from age 25 to 35 was so powerful that even Sam's massive 30-year effort couldn't close the gap. That is your real advantage. The sooner you start, the more time you give the magic of compounding to work for you. Before investing, build your base. 1. Emergency fund. Start with $501,000. This protects you from unexpected expenses so you don't sell investments at the wrong time. 2. High-interest debt. If your debt is above 7 to 8% interest, focus on paying it off first. That's a guaranteed return. Now that you have a solid financial foundation, where should you actually put your money to work? For most people starting out, the journey begins with 2 powerful tax-advantaged accounts, the 401k and the Roth IRA. Think of these not as investments themselves, but as special containers that hold your investments and give them amazing tax benefits. Let's start with the one you get at work. First up is the 401k. This is a retirement savings plan sponsored by your employer. The process is seamless. A portion of each paycheck is automatically deducted and invested before you even have a chance to spend it. This pay-yourself-first method is incredibly effective for building wealth consistently. The single most important feature of a 401k, and the reason it's number one on our list, is the employer match. This is essentially free money. For example, a common matching formula is 100% of your contributions up to, say, 5% of your salary. If you contribute 5%, your employer adds another 5%. You've just achieved an immediate 100% return on your investment. No other investment can guarantee that. Failing to contribute enough to get the full match is like turning down a raise. It's the best deal in finance. Next, we have the Roth IRA. IRA stands for Individual Retirement Account. The individual part is key. You open this account on your own with a brokerage of your choice. This gives you total freedom over your investment options, unlike a 401k, which typically has a limited menu. With a Roth IRA, you invest after-tax money. This means you pay taxes on your contributions today. But here's the magic. Once that money is in the account, it grows completely tax-free. And when you retire and start taking money out, all of those withdrawals, both your original contributions and all the growth, are 100% tax-free. This is incredibly powerful, especially if you expect to be in a higher tax bracket in the future. So, what's the simple order of operations? It's a clear three-step process. First, contribute to your 401k just enough to get the full employer match. Don't leave any free money on the table. Second, once you've secured the match, direct your focus to maxing out your Roth IRA contributions for the year. Third, if you still have money left to invest after maxing out your Roth IRA, go back to your 401k and increase your contributions there. Following this simple hierarchy ensures you're making the most of these powerful accounts. Now for the big question. What should you actually invest in? With your account open, the options can feel overwhelming. You might hear stories about people getting rich picking the next big stock, and it's tempting to try and find that one company that will skyrocket your portfolio. But let's be clear, this strategy, known as stock picking, is incredibly risky. For every success story, there are thousands who lost money. Even professional fund managers struggle to consistently beat the market average. For most of us, picking individual stocks is less like investing and more like gambling. There's a much smarter and safer way to build wealth. The answer is to use ETFs. ETF stands for Exchange Traded Fund. Think of it as a basket that holds a collection of many different investments. Instead of buying one company, you're buying a small piece of hundreds or even thousands of companies all at once. This is the power of diversification. Buying a single stock is like betting on one horse in a race. If it wins, you win big. But if it stumbles, you lose. Buying an ETF is like betting on every horse. You won't get the massive payout from one winner, but you're much more likely to get a solid average return from the entire field. Let's look at a few popular examples. A great starting point is an ETF like VTI, the Vanguard Total Stock Market ETF. This single fund gives you exposure to the entire U.S. stock market, over 3,500 companies, from giants like Apple and Microsoft to thousands of smaller companies. To diversify even further, an ETF like VT, the Vanguard Total World Stock ETF, adds thousands of international companies from Europe, Asia, and beyond. This provides an extra layer of diversification, so you're not solely dependent on the U.S. economy. Another common type is an S&P 500 ETF, like SPI or VOO. This fund tracks the 500 largest U.S. companies. While less broad than a total market fund, it's still a fantastic diversified investment. So, why are ETFs so powerful? First, instant diversification reduces your risk. Second, simplicity. You can build a globally diversified portfolio with just one or two funds. And third, they are designed for steady, long-term growth. The smart strategy isn't about being a genius stock picker, it's about discipline and consistency. Invest regularly in low-cost, broad-market ETFs and adopt a long-term mindset. Let compound growth do the heavy lifting for you. So whether you're in your 20s or even your 30s and beyond, the best time to start investing is now, because waiting for the perfect time usually means missing the opportunity. If this video helped you understand investing better, like the video and subscribe for more simple breakdowns on money and investing. And in the comments, are you starting with your 401k or your Roth IRA? Type match or Roth.